It's becoming a bit of a common theme actually for the small caps. So how do you invest in this sector given the current market volatility? What happens if rates do rise and rise more aggressively as these Fed members keep telling us they're going to do? Marc Whittaker from Investors Mutual is back with us and here in studio. Hey Marc.
Hi Dean, how are you?
Very well, thank you. Volatile times, this we know, but yes, opportunities as well. I mean, is that in particular for certain sectors within the small caps? Is it particular to the sector in general? I mean, how does small caps generally perform in an era of rising rates?
Well, typically it's not great for small caps. I think it does tend to bring to the fore your ability to pick the right sorts of stocks, and you're right about volatility. I think that's going to be a dominant theme for all sectors of the market and small caps in particular across the next 12 to 18 months. It's interesting where we sit at the moment with where the Fed is. I guess the key question is, are they ahead of the curve or behind the curve when it comes to inflation, and just how entrenched inflation is. One thing we do know about inflation, and a lot of us haven't actually sat through an inflationary cycle. I'd like to think I'm too young to have done that previously, but what we do know about inflation is once it becomes entrenched, and it's entrenched in consumer psychology, and it becomes a wage increase issue, it's very hard to break the back of, and that's really the challenge for the Fed at the moment. How do they break the back of inflation? And typically that's on the back of very aggressive rate rises, and typically when we see that, we do see growth start to pull back quite materially, and that has a particular relevance for small caps, which are really on the growth end of the economy and markets generally. So yes, we would expect it to be a volatile period for inflation. So the question is, what do you do in that type of environment? And really, again, as we would argue, as it always does, it comes back to fundamentals and really picking the right bottom-up stocks. What stocks are really going to hold up well in a time of perhaps economic dislocation or uncertainty, and really thinking about those sorts of stocks that you want to own in your portfolio. I think now, even though we're seeing the small caps perform really well, and that's on the back of a lot of the hard commodity exposures doing well, I think small caps are up over 4% for the month. That's quite a contrast to what we're seeing in terms of inflation, consumer confidence starting to roll over a little bit, and so forth. So it's an interesting time.
Now, it's the big end of town, but we had Fisher & Paykel today warning that freight costs will be impacting margins, going forward. Absolutely. So when you think about...
We had a KMD group, Kathmandu as well, saying similar things as well. So it's a common theme, it's coming across from most management teams. So is that something that you're really speaking with management teams about now in particular? Well, it's about the types of companies that can absorb those costs and pass them on, right? So that's part of the fundamental analysis you want to be undertaking. What are the price-making companies in the market that you can own with some confidence, with resilient end demand? So if we think about perhaps the consumer becoming a little bit less certain about their future prospects, inflation, petrol prices going up, your disposable income perhaps not what it was this time last year. Now, what are the price makers? What are the companies with resilient end demand that can hold up through a volatile time, this part of the cycle? I think they're the sorts of questions you want to be asking. And of course, I'm here to give you the answers. So
well, what is the answer? So give me an example of a company that does have pricing power, that demand will remain firm, even in an inflationary environment, even as consumers maybe have to make choices as to what they're spending their money on.
So we talked about hard commodities, I think, on that list of stocks you had performing well, but I think soft commodities is an equally good space to focus on. And I think soft commodities are good because at the end of the day, people have to eat. The demand for protein is always growing. So I like Tassal as an exposure. It's the leading salmon farmer in the country. Yes, absolutely. So what we like about Tassal in particular at the moment is that there's been a very strong refocus in that business towards capital efficiency and capital allocation. So they're really focusing on generating good free cash. So when we think about stocks we want to own, yes, companies with resilient end demand, so the demand for salmon, the demand for protein is not going away. If anything, that demand is increasing. And that's not just a local phenomenon, that's a global phenomenon. So they've got very viable and healthy export markets as well. So it's not just about selling salmon into the local market, but consumer demand offshore as well. They've got a very strong focus on generating good free cash, and the last result they had back in February demonstrated their ability to generate very strong free cash as well. And we like the fact that the market structure around salmon in Australia is actually improving. So their major competitor, Hewins, has been bought out recently by JBS, and that's brought a whole new level of rationality to the industry. So thinking about, let's not just invest in capacity and production for production's sake, but what are the best outcomes for consumers and for the industry at the same time. So we're starting to see a stabilisation of new volume or new production come online, which bodes really well for their ability to push price through. And we have seen very good price gains in the supermarket channel. So the ability of Tassal to go to Woolworths and Coles and say, guess what, guys? We're putting up the price of our products this month. Is very strong at the moment, and we would expect that to continue.
Do you at Investors Mutual have an ESG layer, and how does Tassal hold up against that?
We do. Look, there is some voice and some issues raised about their onshore salmon farming. A lot of what they do today is actually moved offshore. So if you think about Tasmania and salmon farming down there, a lot of the salmon farming traditionally has been in, I guess, on ground lakes and so forth. That's been increasingly moving offshore. So the issues around nitrogen in the water and fish waste and how that accumulates on the ocean bed or the lake bed is becoming less of an issue in our mind. At the same time, you've got to think about what are the alternatives. People need to eat.
Yep.
The demand for protein is growing all the time. There's a weighing of the pros and cons, and I think Tassal for sure is certainly best in class when it comes to global relativities. I think there's little debate about that. And if you look at the likes of salmon production in Chile, in Norway, that the issues that they face environmentally are far more pressing than what you find down here.
All right, so Tassal, I had salmon last night. And,
good, it is lunchtime, so I thought we'd talk about it as well.
Now, you bring up soft commodities. Yes. And we know that everything from elders, but to the fertilizer companies have been doing well, that are leveraged to that sort of, sector. So is there a preferred method, or do you invest in that theme?
We do. As I say, we like soft commodities. It's not only just about owning the commodity producers themselves, but it's also about companies that are exposed to that thematic. So suppliers into that commodity channel, because they will benefit as well. If demand's strong for soft commodities, pricing is strong, your ability to supply into that particular part of the market will also be strong, and you may be able to take price, but demand and volumes will be very good as well. So we like Ridley, which is the leading livestock sort of food producer or food provider into the agricultural markets in Australia. Now, the one thing about agriculture in Australia is that it is corporatising. So there's less and less farmers around, but the size of the farms is getting bigger. So it's becoming a very corporate sector. And as they grow scale and as they become more corporatised, they are looking for scale suppliers to supply into them as well. So Ridley is really one of the largest and sort of mega scale providers of feedstock into the agricultural sector. So we like that. Under Quinton, the relatively new CEO, we think he's done a really good job of consolidating the footprint. So in the past, if you thought about Ridley, they probably had too many mills, they had too many rendering plants, and a lot of those were subscale and inefficient. He's really collapsed that footprint into what is a far more optimal arrangement. So what we're seeing is volume go through, or increasing volumes go through this consolidated footprint. So you're getting a whole level of efficiency benefits, scale benefits. So his ability to hold price, not necessarily put up prices, but hold price, but sell more is really deriving great efficiency benefits for them. So it's really quite powerful.
Pretty good looking chart over the past year as well.
It has broken out recently past its typical range, and that's on the back of what we think is a very transformational dynamic around the company.
Good. So, and on the list, because I do get a heads up sometimes for these things, I've got Integral Diagnostics. So how does that Integral Diagnostics, sorry. IDEX is the ticker code. What? It is. How does this fitting in with this inflationary theme?
It's certainly not a soft commodity player, but we're thinking about companies with resilient end demand as well. So we like the commodities because the soft commodities, because that end demand's there. Healthcare is also another sector where we're going to see end demand hold up really well, even if the economy slows, even God forbid we see negative economic growth. Healthcare demand will continue to grow. We've certainly got a backlog of elective procedures which were abated during COVID lockdowns, and they're coming back. So IDEX is the 4th largest radiology company in the country. Recently made an acquisition in Queensland which really fleshed out its Queensland footprint. So we like the fact that where it operates, IDEX, it operates in Queensland, it operates in Victoria, it operates in Western Australia. It has a hub and spoke model, so it will really dominate a catchment and then really fill out that catchment area. So the most recent acquisition they made was another acquisition in Queensland, which really adds to that hub and spoke economic model that they have in Queensland. So we really like that. We like management. We like the fact that they can continue to grow through acquisitions. A lot of people would have questioned their ability to make additional scale M&A, but they've proven their ability to do that again with this most recent acquisition. And as I say, they're really benefiting from two very strong tailwinds. One is the ageing demographic, clearly, and the second one is the ability of technology to really prove up radiology as a preventative form of medicine as well, to diagnose additional and ever-increasing diagnoses as well. So that's quite powerful. They do have indexation on many parts of what they offer into the MBS and other healthcare. They can also charge co-pay payments as well, so their ability to grow and flex that revenue line is also quite good.